The stock market has just raised the alarm. The rare canary signal is now live. So, what does it mean for us as traders and investors currently in markets? And could we be still seeing a relief rally just around the corner? With the golden pocket being reached on both the S&P 500, Nasdaq, and equal weighted market, there's a lot of what we call confluence going on right now. And this happens when two other things are occurring. The Nasdaq failed to make a lower low, which could be a sign of strength, and dark pools are at it again. Some of the biggest trades we've seen in the last 2 years just went through over the last 48 hours. So what should we be doing right now? Well, in today's video, we'll take a look at some of the biggest reads across stocks, commodities, and cryptos. There's a lot to discuss, and this is going to be a great one. See you in a moment. Well, welcome back, everybody, to a sea of mixed reactions as we saw the inflation numbers come out around the US. Some numbers look good, some looked kind of worse, and of course, we still haven't seen the technical impacts of tariffs, which will come through in next month. So what exactly is happening right now in markets? Well, it was a relief rally through two of the most sold market areas, both semiconductors and Tesla, bouncing off some of these key correlation points. And that's something we want to discuss in today's video as we see some differences in opinion on what's exactly happening at these levels. Let's begin though with the inflation breakdown. Basically, it beat estimates. We saw a slightly cooler inflation, and in general, it was helped by gasoline. But the main thing here is that food still remains relatively volatile. And of course, shelter was the big concern. Still up and still the most sticky of the overall inflation reads, up 0.3%, and it nearly accounted for half of the total increase. So is it a good result? Yeah, it's not too bad, but it didn't really move the markets as much as people would think. And part of this reason why is we haven't been able to build structure yet. In today's video, we'll take a look at where you should be watching structure on all of the markets, but have a look at this one we posted over on our X account. The S&P 500, equal weighted market, and Nasdaq all hit the 61.8 Fibonacci level. And this is taken from the 2024 August lows. So why is this important? Well, of course, this level here is often synonymous with big hedge fund and big Wall Street buying. The golden pocket, or golden fib as it's known, with the 61.8 is one of the most popular levels used in markets, and this is one of the most popular swing zones that you're going to see people charting. At the same time, you may notice something very interesting here, which is the most sold market, being the Nasdaq, actually has found a little bit more wick purchasing over the last 24 hours, and this seems to be following through on a few things that we're about to see, including dark pool liquidity. But let's take a look at the epic collapses of companies that rely on risk seeking. Just a few weeks ago, everybody was on board the risky stocks. And of course, since the election, that has been the main discussion. By anything that potentially was 2021 style stocks, including things such as the ARK funds, Coin, Hood, IBKR, Penn, DKNG, and many others. And they were on the rise, including Reddit, all the way to the top. Since then, we've seen 31% wiped off these, and some stocks have actually gotten even worse. So is it now time for a bit of a recovery? Well, let's take a look at the big trades that have come through. Now, we've seen some monsters over the last couple of months. We saw the second and first largest fund trades on IVV, that is the S&P 500 ETF, one of the most popular in the world, and we saw them all up here in the highs. And of course, it makes us speculate that maybe this was a huge sell from Wall Street, something we've talked about a little bit in the past. But something did happen that is encouraging. Right at the lows, right near the close, someone placed the 8th largest trade we've seen in the last 2 years. And this is a pretty big deal because, of course, where big trades lie, often big traders and investors can start to change the market sentiment. And the same thing happened, as it turns out, on the Nasdaq. Yes, the Qs, which we all know is the number one ETF in terms of the Nasdaq, actually saw the 4th largest trade, and it just tends to marry up here well with the 3rd largest that we saw before the breakout back in October. Now, why is this key? Well, this level is clearly being defended, and as it is also the golden pocket, or the 61.8 fib, we have to be paying attention to it. Now, a lot of people will cite something we'll look at later on today's video, which is that we've seen a lot of big buyers all around these prices. And of course, since then, the market has dropped more. But is that to be expected? Well, yeah, it is pretty much, guys. This is something that we generally do see. And of course, the key here is that remember, most big traders, most big investors don't have stop losses, and therefore it's not the same as a normal retail purchase. They don't mind if the market goes down a little bit more. I'm sure they don't like it, but they end up buying on a grid. And you've got to think about it as they purchase prices up and down to a certain point. They might say, this is where we start buying, this is where we buy more, this is where we get super excited. And that super excited movement ends up as a wick. And of course, that's why we often look for wicks in markets. And I always say they hold excitement of the market. But the story gets a little bit better that we might be starting to find some support. Why is this? Well, probably someone closed their massive semiconductor short. The SOXs, the Direction Daily Semiconductor Bear Fund, ended up seeing the 30th largest trade dark pool right at the peaks, which is most likely a take profit, as we've seen a little bit of a push up in Nvidia. So big traders have probably dropped some of their shorts around these levels as the inflation numbers came in pretty strong. Now, why else could we be seeing potential lows? Well, the answer is basically exhaustion. Some of the indicators that I like to use have printed extreme exhaustion. And you might say, well, yeah, Tom, or, of course we've seen oversell, but it's very important to see all of these things correlate with each other. The value of put volume is now up there with only one other time, which of course was the September-October lows of 2022, and that epic low of March 2020. So we are now in the third biggest, basically, put purchasing program since 2020, which is a big deal because these were significant lows. These were points where we went into a bear market. Remember, we only ended up 10% down so far, which, by the way, hits the stat that we were looking for this year. We did predict, and we don't like to predict too often, but we did predict on this channel together that we would get a 10% sell-off this year, and that it was probably going to happen in Q1 or Q3, most likely. And of course, we also know that the market is nowhere near technically down as much. So to see puts up here already, reaching for that third largest level, that's a pretty big key here from Subu Trade. We also know the Russell ended up 6 consecutive weeks down last week, which is usually a turning point. Traditionally, the Russell will end up bouncing after the 6th week. And of course, we'll find out. We've got 2 more trade days, and we need to, of course, end positive for this stat to hold. But it's still another one that you can hold through. We also know JP Morgan, according to the latest data, said that they thought 90% of the sell-off was done based on momentum selling, and that was just before the market gave up 5,700. So, of course, since then, we've dropped down to about 5,500-ish, and then, of course, we've seen a bounce. So, yeah, I mean, realistically, this all kind of makes sense as well. So this data, the stats, all those types of things are playing together. Now, we mentioned that we've confirmed a canary signal. Now, what is a canary signal? Well, canary signal is basically a point here where we reach a key zone to do with the 200-day SMA. And you know that we always tend to look at the 200-day SMA because there is another stat we'll share in a moment that is a very, very worrying one, which of course has to do with the 2000s period and the 2008 period, and indeed, actually the 2022 period, which all led to bear markets. Now, the thing about canary signal is that we do trigger them quite a lot. So it's all about where is it? If a canary signal comes out after a massive sell-off, are you going to worry about it? The answer is quite simply no. If a canary signal is happening near highs, are you going to pay attention to it? It's something that you would stack on. So basically, the red lines indicate the first 5% decline from a 52-week high that has taken place within 15 trading days. Red dots indicate price confirmation of a 5% canary signal based on the index experienced 2 consecutive closes below the 200-day SMA within 42 days of the 5% canary signal. So basically, it's showing you that it's a point where markets can often have an inflection. Some of the biggest sells of all time have happened off these levels. But as you can see here, the data is not sufficient enough. What it does stack up well with, though, is the other one, which is the NASDAQ falling underneath the 200-day moving average and then falling another 3.5% plus over the next 2 weeks. Of course, we gave this to you guys last week based on Jason Gottfried's data, and he found that if the market was to sell further, with quite a few reads here in terms of data stats, we ended up with some shocking numbers. If we had a drawdown over 3.5%, which we did on Monday, then we entered into the worst periods that you can really think of over the last 2 decades. Now, does that mean that the market is just going to go absolutely collapse and everything's going to turn terrible? Well, of course not. It's another warning signal that you have to take into consideration with other things that we'll do today. And it certainly doesn't mean that you won't get recovery. In fact, upon my studies of this particular signal, what I found is that markets would recover significantly after these types of sell-offs. And in many cases, they would make all-time highs. So you got to keep that in the back of your mind. So let's take a look at another factor that's going on right now in the markets, and that has to do with the collapse. And of course, it's not just options, it's momentum funds. Take a look at the collapse of CTAs, commodity trade advisors. They are absolutely diving down, and they've just reached a level that we haven't seen since 2023 lows. And of course, an epic sell-off that was ended up being a buy. So have we reached the over extreme levels? Well, of course, when you look at percentage of stocks above the 20, the 50, and the 200, you'll notice a lot of those are starting to come down to those key points. And I think it brings up another area that we just mentioned. In some of the stats that we've seen before, such as that one with the 200-day moving average and the NASDAQ, we could make an all-time high still. Now, why is that important? Well, February has only been a peak once since the 1980s. Most peaks tend to appear January, December kind of period, and the later half of the year, the last part, the October, November kind of zone. So could it be that we've really hit an all-time high in Feb? It's possible, but statistically less likely. And of course, when you stack that up with some of the other data points we've been looking at recently, which is huge amounts of up, down, and all around, 6 consecutive days of -1, +1 change, while still not below 20%. That's important because it means we're not in that bear market psycho volatility that you tend to get. People forget about that. Go do the study. We'll have to do a special on this soon because, yeah, we need to study and look back at what really markets look like when they go absolutely collapse. Because while this was a big sell-off in certain stocks, generally speaking, it gets a lot more wild. And I think we do forget as humans. I always say we have goldfish memories. What do you guys think? Let us know in the comment down below. Would you agree we have goldfish memories? I tend to believe we do. 1 to 2 weeks later, of course, mixed results. But realistically, you go to 2 months later after these stats, 3 months later, 6 months later. These are some mega stats towards the positive side. So maybe it's suggesting that we do get rallies. We obviously should go back to the 200-day at some point. We'll talk about that soon in today's video. But then do we get an all-time high? Well, these stats kind of confirm that at least we could get some nice recoveries. Now, is it normal to happen around here? You could say, okay, what about the tariffs? The tariffs. Well, of course, we were already told about those a long time ago, and the market did know. The thing is, though, that maybe it didn't expect the speed, the ferocity, all of those types of things. And there's always a reason for why we sell off. But you may not be aware that it is pretty normal for markets to sell and to be up and down all around at this point of the year. In fact, if you look here, the second week of March lows are common. Lows is the key word here, are common over the past 2 decades. So could it be that we've actually hit the timing as well for a low? Well, we know retail traders have been liquidated at massive levels, hopefully not you guys. And JP Morgan actually saw the number one since tracking this data just happening the other day. The first hour, there was like $1.2 billion of liquidations, basically just like that. So very, very quick, like a click of a finger. We also know that leverage traders and that bigger funds have started to buy things such as the MAGs, which did fall under this level straight after these purchases. So it kind of went like this, and we're trading around here right now. But this again marks potential lows. We've got dark pools there. We've got dark pools on IWY. Gamma stocks usually lead out of these sell-offs. And of course, another one that was a winner over the last 24 hours was Tesla, where we saw a big bounce off that 220 area. And the 220 area was not only a put level, but it was also an extremely big trade level previously. So again, something that you would probably expect to occur. So some levels are being defended here by the markets. Let's have a look at the cryptoverse. Of course, Bitcoin getting an oversell the other day based on the RSI. That's a good sign. Of course, it means it could be oversold. And we've also got here Bitcoin flows continuing to look kind of negative. So that's, I guess, against it. In general, though, I think that when you're looking at these crypto markets, you have to be looking at the S&P 500. You have to say, are we going to get risk on? Is the NASDAQ moving up? The NASDAQ's often synonymous with the Bitcoin kind of markets, and also, of course, the risk on philosophy. So I wanted to say a big thank you to Nicodem recently, who has just posted a review of our course and our private community. I thought the thing that was really stand out here is that he's quite young and that he is really impressed, not only with the content, but more importantly, with the decisions that he has now made and empowered to make on markets, including investment, swing trading, day trading, and all of those types of things. Big shout out to him, and obviously I hope he continues to do very well. If you're interested in more things like that, check out the link and the pinned comment down below, and you can follow us on some of the other socials and also check out our courses. All right, let's have a look here at what's going on in the semiconductor world and more importantly, the rotation. So it was a risk on day. Even though the market actually didn't move as much as some people would suspect, you had semiconductors, a beaten down market. You had, of course, big tech, beaten down market. And the other two, which is the regional banks, which has been getting thrashed recently, and of course, consumer discretionary. Now, all the defensives, including the one that I've liked recently, which has been healthcare, were down. And that's because if you are going to rally out of this drop, then generally you will need those big gamma stocks, at least initially. You can see here on a 5-day roll, then we've got a totally different scenario in terms of what's been up and what's been down. And funnily enough, energy's been up, even though we have been seeing the markets at these critical levels. That is, they've been falling, and oil in particular is sitting right on that 65 to 67 zone, which is such an important support level, and we'll have to look at that when we get a break either way. Let's take a look at S&P 500 now. So we've got superior oversold signals. This is an absolutely exhausted market to the sell side. It's still possible as we're in negative gamma to get towards 5,400, 54.75. These are the two kind of key zones that may be reached. 54.75 is the most traded zone. 5,400 is the clear level of support or demand. Now, that being said, are we starting to see improvement in structure? Well, let's take a look at the futures market. So you can see here after the inflation numbers, these are the updated options levels, by the way, guys, and of course the levels we're talking about. But you can see here that we had a bit of a drop, and we actually put in the first higher high for a while. So the whole way down here, it's just been a series of lower lows and lower highs. Now, it's not the higher high I like, and the higher high I usually like is it actually closes. And why is a close key? Well, a close means that the market is sticking that point and saying, you know what, yes, as buyers, we are in control. We're actually looking to pick it back up. But it's an encouraging sign nonetheless. And along with the dark pool activity that we've been seeing, and of course, the significant puts, which you'll now see sitting particularly on 5,600, this is a very key level for markets. Could we drop a little bit? Sure. But if you actually mark it out, let's have a look here. What's probably the worst case at this stage? Probably around this 3.71. And of course, the uptick, that is the uptick just to certain key levels. And we'll actually add this together. Let's add the moving average here. So what we're going to do is we're going to add a simple moving average together, and we're going to add the 200. And the reason we're doing this is because the 200 moving average is the level that we just broke. This is that key zone that many traders and investors look at. Now, if you have a look here, we're still quite far away from that. In fact, let's actually measure out how far away we are from the 200. We're about 2.5%. Now, as it turns out, that particular level is generally going to be reached. Now, whenever you drop below the 200, at least over the last decade anyway, it always loves coming back and having a tap for that zone. So whether it does it here or whether it does it here, or even possibly even lower, I mean, anything's possible. It's unlikely, but it's possible. This zone will most likely get tapped. And that's why it's important to note, where were all the dark pool buyers? They all bought at around 5,700 to 5,750. Now, why that is key is because they might want to sell out. Potentially, they may want to close positions here, and we'll need to look for dark pools. But this is the level that you would have to expect the market to, at minimum, bounce towards. And of course, we expect probably a little bit better bouncing in the future. Now, these zones, as you can see here, will act as supply. So I would look at 5750 on the way up as a possible resistance point, as it is most likely the supply zone. And yeah, there's a lot kind of to go through. But what we mentioned before was the key, and I think it is that we have a difference between the NASDAQ and the S&P. I noticed this before I was doing the private stream yesterday, and obviously I mentioned it around here in terms of price. But the thing was that NASDAQ didn't make a new lower low. Notice the S&P 500 at the same time does, but the NASDAQ didn't. That suggests there is slightly more strength coming through this market. And that could mean that gamma stocks in particular are starting to get a little bit more of a pickup. Let's now take a look at why the options market could hold the key as well. 5,500, 5,600. What massive strikes these are. Remember, we're coming up to the OPEX, which is the quad witching this month. And that is a massive, massive liquidation event that could occur. And we have 5,500, 5,600, and 5,700 all being massive put levels. We are in complete negative gamma. But if I was a market maker, I would be trying to push that market up. I would be trying to get that thing above 5,700 so I can make some sweet money. And of course, I'm sure that's what they're thinking about doing rather than hedge it off. You have to assume, of course, that retailers bought a lot of puts recently. I would guess that is true. I don't see that part of the book, neither do you, but this is a key level, and 5,600 is, of course, the current most struck level on the next day of 0DTE's 13th. And of course, as we go through to the 14th, you can see here 56 also well struck, 5550 and 5500. So all well struck. Negative gamma still is in play though. So until we see real structural change, you've got to assume that the bears are in control. Let's have a look now at a couple of other markets. First up, we'll start here with NVIDIA. And as you guys can see, NVIDIA's changed a little bit in structure over the last couple of days. We went from being at that 105, 110 level to all of a sudden back to the most traded zone, 115. Great levels do hold, guys, and you always get a chance usually to get out. So 115's been reached, and you guys can see all of a sudden we're almost back in positive gamma territory. And the markets, if they push through 115, 116, suddenly are actually looking bullish again in terms of just the option side. And of course, I believe in price action, if we get past 120, we're really putting in a good structural zone for NVIDIA. So again, could the relief rally be coming sooner rather than later? Some stocks have already started to see it. Another one's been the Tesla stock market. And of course, that went down to 220. If you bought there and you were brave enough, congrats to you. There's pretty big gains over the last 2 sessions. And we're back at 250. And of course, the 250, 260 core wall is the main key. So we'll be watching that one very, very closely. Let's jump on over to the lead indicators. What's going on now in terms of the general broader market? First up, bonds. Not looking the best, I got to say. They've actually continued to drop. Now, this is my personal bond indicator, and I always look at this and say, well, you know, if it makes a lower low, I'm terrified a bit more. And in this case, it's still holding structure, of course, but it's coming down to where it really needs to start turning around. So are the bonds market panicking? They're starting to. That's in key because that could be a big problem. Now, the more lead indicator here in terms of just the shorter time frame moves has continued to accelerate. Now, what this is of course, this is the bond market options yield. So basically, this is how freaked out everyone is, and that continues to rise. Now, traditionally, to put a bottom in the S&P or the NASDAQ, we need to see that have a nice big drop. And you'll notice that when you go through some of the other periods, when we've seen these types of levels, we look for these drops first, and that often is dropping. The market will actually be dropping around that same point. So this I'd love to see get collapsed back on and push back, because that would mean that we've got a good chance that that is a real buy. Another one is home builders. Obviously, home builders here putting pressure on that downside. Not a good sign if it breaks the low. That's bad economically. Of course, it's not what you want to see. And a couple of other reads that we've got is the American consumer, which we often look at. Bit of a bounce here off the support, but still was in free fall. A worry for longer term investors, something of course we need to be looking at. And the last one was the VIX. We mentioned that on the previous video. We were looking for decline in VIX, and we did get it. So I would like to see the bonds market decline with the VIX if that was occurring in terms of the overall, freak outness of the bonds. And if that is happening, that is a great, great, great sign that along with the price action you're basing off. Remember, it's about building the confluence story, which we like to do here on the channel. And so far, the VIX has been collapsed a little bit, which of course is another good sign that we could be forming some kind of base around this level. What about the US dollar? Well, it continues to drop, and it continues to help a few of the trades that we've been mentioning. The big thing here is the dollar we expect to continue to be weak throughout the year. At least that's our forecast from the start of this year. So I wouldn't mind this type of thing to occur where it jumps up a little bit and then drops back down. But the real winner of this trade has got to be euro traders. If you were in the euro US dollar long, which we've been talking about on and off for the entirety of this year and actually late last year, that was a patience pays kind of trade, and it certainly has paid off in recent times. What about gold? Well, it's starting to push to the upside. Geopolitical tension, everything else that's going on helps gold. Of course, it could be getting there to the magical 3,000 that we've talked about for a year and a half, 2 years. And of course, I'm actually thinking gold is higher. I'm thinking 3,600 potentially here from gold. The one that's actually more exciting, though, in terms of percentages for us, has to be silver. And silver broke out again. So we've got big breakout here from silver. It's managed to get back up. We're going back to those periods we were at based on last year. And there's actually been some crazy percentage gains on silver if you think about it. 15% up here from the lows of just a few weeks ago. I mean, it was only 2 months ago, 2.5 months ago. And silver is starting to break out. Now, if it closes weekly strong, let's say we get above 33.80, we get above 34, as it already is looking pretty good, that's going to potentially signal real on risk for silver. That is, people will start to really move into that particular market. Treasuries, of course, disappointing, but filled gap. That's okay. Again, you'll be looking for yields here. We'll have a special on yields moving forward, but you can see the 10-year and the 20-year and the 30-year all kind of consolidating at around these areas. And then we move on to stock. So Tesla gets the bounce. Tesla bounces. Look, I said this to our private community. I'll say it to you guys. We obviously talk about it here together. 250 or 220, both very big levels for Tesla. If you bought 250 only a few days ago, you're back. You're back to being green or at least flat. That's the kind of level that, if you're going to buy dips, you buy super, super keys because you do generally get at least an opportunity out. Generally, whenever you're looking for these types of rallies, you're going for at least mean reversion. Now, traditionally, mean reversion is a 20 weekly moving average, but in these very aggressive kind of markets, you're looking for that 20 moving average. So I think that's what a few people will be looking for. Could it be that the low of Tesla is printed? It could. It's not going to be one that's easy to take in terms of just pure structure. It's just a buy the dip kind of guessing kind of thing. But I did get exhaustion reads similar to what I've seen on the S&P, on the NASDAQ and some other markets, all on Tesla and also on NVIDIA. And you can see here the exhaustion reads. So these are extreme exhaustion reads that we have in our advanced course. And the big thing here is that the key levels, again, being reached, 115. You buy, let's say the level here, it's a good level. Yeah, it gets horrible, but ultimately it comes back. So now we're faced with a dilemma. Will the market continue to rally? Well, I think possibly. The inflation number came in a little bit better. NVIDIA and others have hit lows and started to bounce back up. And of course, we look at the mags because let's take a look at what pretty much is the most important market in the world. And it has kind of almost island reversed. It gapped down, it gapped back up. So that's technically an island reverse. You've got volume, of course, on the rise. You've got here a bit of a demand level. So we previously saw a lot of transactions go through here, and it ended up close to its highs for the session. So what if we get past 48? Well, that's going to be showing you that the Mag 7, that is the ones that went into a technical bear market from the top to the bottom, dropping 20%, are starting to recover. So that's kind of a key thing we need to be looking for. Of course, healthcare, one of my favorites for the year, and I want to reiterate that it's for the year, not for just a few weeks, that's dropped. Now, that's not unexpected. As the market rotates out of defensives, it will generally go into the gamma stocks. And of course, you have to expect, at least during the initial part of a bounce, for those gamma stocks to do better and the healthcare and defensive sides to do worse. So if you have a look here at XLP, look at that, massive down. Again, the money is flowing out of the defensives the last 2 days in particular, and it seems to be going into these other stocks. So that is key. If you have a look at something like Reddit, while Reddit has been absolutely thrashed, you can see here actually the percentages have made a big turn. And you've got to be careful on these types of markets, guys. But as you can see here, that is no slouch of a drop. That is an absolute mega drop. Let's just take the percentage here just so you get a bit of an idea. That is 54% in a matter of weeks. So there's some big wipeouts here and something that's been strong. But because they were strong, they will have some form of buyer demand at some point, and maybe we've reached that. HSI, we like Chinese stocks at the moment. We have for about a year and a half. And yeah, they're just recovering. Still a series of higher highs and higher lows. There's no real change here to this market. It's still bullish and intact at this point. What about US 2K? Well, that is another story. You can see here the US 2K is long leg doji or doji-like. It's not really finding much buy pressure. I think the thing here with the US 2K is we really need to see a structural improvement, and we just haven't got that. Generally, that's going to be led by, you guessed it, the NASDAQ. and the NASDAQ didn't make a lower low, so it's slowly improving. So if we just kind of get rid of this stuff here and we have a look at the daily, what you'll notice with the NASDAQ is it's got that doji and it hasn't closed above it. So it'd be quite nice to see it close above that. As always, we use the S&P 500, so we're going to want that close above the level of 56, kind of 70. We've already seen some structural improvement. This is all small day trade stuff. We'll talk about swing if we actually do get a big day. But most people are going to be angling for, you guessed it, the daily 20. They're going to be looking for a recovery into the daily 20. And then, of course, we'll see whether this market's really got the stuff to move back up. So for now, negative gamma still holds here in the markets. Of course, options markets are just holding on by a thread in terms of these key levels and what the big dealers want to do for it. We've got pretty much a liquidation event that just occurred on Monday, that peak maximum fear. And there are both bullish and bearish case scenarios. It's really just starting to stack up. Is the bullish case scenario and the worst case scenario at the moment looking better than the bear? And I would say it probably is. From the Ethereum side, nothing much to really report. Obviously want to see 2,000 plus broken. And as always, you're really looking at Bitcoin. It's like the S&P 500 for crypto. And what do you need? You need an 84K plus, something we've mentioned a few times. Why? Because at the moment, this is like an inverse head and shoulders, and that at least could give some relief in terms of the rally. Currently, everything is, of course, down, and you can see here that the market did close near its low, but it has bounced a little bit post CPI, and we'll see whether it can get through 84K. In terms of news coming, we still have more news. We've got PPI. A lot of these tariffs could be hitting into the PPI, which I think is why the market's sitting. So the big thing here is, what exactly is going to happen to services. And of course, we may start to see that a little bit. And then we've got here UOM consumer sentiment on Friday at 10 a.m. Guys, I hope you enjoyed today's video. If you did, please give it a like. Give it of course, set those alerts for this week because we'll be coming at you with a whole bunch of information. And follow us over on X, and also check out our flash sale on our courses. I'd have to suggest, if you're interested in finding out more about our cycle analysis, how we figured out defensives earlier this year, and of course, gold, China, and other markets, then check that out. The advanced course is awesome. Thank you so much. I hope you had a great day. Good luck. We'll see you in the next one. Bye for now.